let's start with Netflix. First quarter profits came in higher than expected. They added 2.2 million subscribers. That's more
in the U.S.
In the U.S., they were expecting 1.8 million. I mean, on balance, this looks really good, and yet the forecast that they gave was a little bit weaker than some on Wall Street were expecting, and that, as much as anything, appears to be sending the stock down 10%.
Yeah, well, Wall Street is so much focused on forecasts and what the next quarter is going to do that I think this is actually a really good opportunity if you're interested in investing in Netflix and either have a smaller position than you might want or no position at all, because down in the 90s and heck, if we're lucky, down in the 80s would be a great place to buy shares. And my broker's headline feed this morning was just saying, reiterating, every analyst out there is saying, reiterating target price 120, target price 130. I mean, that's where these guys are headed. And so if you can buy it in the 90s, you're going to do pretty well.
We were talking about this earlier, Jim. I was confused. Maybe I shouldn't be confused. After doing this podcast for 5 years, I should no longer be surprised by short-term thinking on Wall Street. But part of, I guess, the bear case, if you will, had to do with their international growth,
yep.
Not really being, and yet, was it just 3 months ago we were sitting here talking about how they had hit all of these international markets that they weren't projecting, initially they weren't projecting to hit them for at least another year or two.
At least. Every market they've gone into, they've done better than they expected. Canada, their first international launch, they reached break even like a year ahead of schedule. And they're saying, oh, we got something going here. And then Latin America, where they got 20 or 30 countries all at once, I'm of the opinion that fell in their lap because they had been planning to go elsewhere at that time. And that started out a little bit rocky. They had some payment issues. That might be part of what's affecting the latest 130 country launch. The payments are in U.S. dollars and limited only to if you have a credit card that can handle U.S. dollar transactions. So that might be slowing things down and some of the headwinds, but they're going to work through it. Latin America is a great growth story now for them. All these new markets are going to be a great growth story 4, 5, 6 years down the road. And as longer-term investors, that's where we should be looking. That's where Reed and David Wells and Ted Sarandos, all the chief guys there, are looking. They're looking several years down the road. They're not interested in the next quarter. They're saying this is a 10-year game, folks, and we're playing for that.
Charlie, when you look at what's playing out today in terms of the sell-off, what goes through your mind?
I'm very impressed by not just the quality of the original content that they're able to make, but the pace at which it's coming out. I mean, you remember just a few years ago, they weren't doing anything. And, there's a lot of skepticism about whether Netflix can actually come in and make high-quality TV shows and movies. And I think that's been answered with a resounding yes. And it goes way beyond some of the, high-profile prestige programming like a House of Cards, and you go down the list into like the Aziz Ansari Master of None, the Unbreakable Kimmy Schmidt, all the kids programming, the stand-up comedy. They've got something for everybody in the family, and it's coming out every week. And I think, to Jim's point about thinking long-term with the company, I think that's what people should be focusing on, is that they've been able to make a lot of their viewing consumers happy with all this content they're making. And, the library is just remarkable in my opinion.
And so that raises in people who are thinking bearish on the company, well, all that great content is costing them a lot of money. And for the original content it's all paid up front because the actors and directors and the set people want to be paid, right? There's a big cash spend up front. And so that's why their free cash flow is so bad right now. But there was a telling comment by, I can't remember which of the executives said it. It says, your costs are going up, but our revenue is going up even faster. And that's being shown in the U.S. If you look at the improvement on their contribution margins over the years, that's the cost versus the revenue. And the revenue is growing faster than their costs. And that's what's happening. And that will begin to kick in internationally as the company continues over the next several years.
Let's move on to Illumina, which is having a pretty rough day. Shares down 24% after the biotech company reported preliminary first quarter revenue. which is way below what was initially projected. And Charlie, I think it was just this past weekend on the radio show, we were talking about how anytime a company comes out with preliminary results, they're always bad.
Yeah.
It's never, this quarter's going to be so great, we can't wait to tell you about it.
Yeah. Guys, I got to tell you something.
So,
we really killed it.
So from the stock perspective, it's down 24%. How bad is this? And, as Jim indicated about Netflix, what we're seeing playing out, shares down 10%, maybe a buying opportunity for people, is what's playing out with Illumina, potentially a buying opportunity.
So Illumina is the industry leader in selling DNA sequencing machines and the consumables that go along with it. So they're widely used by research institutions, universities, and the like, and that's transitioning quickly into medical applications as well to do personalized medicine. So they're going to do 572 million sales in Q1, which would be 6% growth, and they pulled down their full year guidance for the year. Originally, they thought they'd grow revenue 16%, and that's going to come in at 12%. The problem there is system sales into Europe are a lot weaker than they thought they were going to be. America and Asia are doing fine, mid-teens growth for them, but it's going to be low single digit in Europe, and they're making some management changes as part of that. And then along with lower unit volume, their profit margins are going to come down as well. I think there's a lot of companies out there that wish their problem was 12% sales growth this year. So let's just put that in some context.
I mean, no question. That is, on a percentage basis, that's a haircut.
Yeah.
But it's still double-digit growth.
It is. And I think the issue is that they are almost a victim of their own success in this regard. This is a company that's grown their sales 20, 25% a year for a very long time. And now that that's coming down back to a little bit more normal numbers versus spectacular numbers, I think you're seeing a little bit of a resetting on the valuation. The stock has just chronically traded at 70, 80 times earnings year in and year out. But you have to deliver the revenue growth to maintain that kind of earnings multiple. And there's just a little bit of a reset going on.
Well, and that ties in with one of the things I read this morning about Netflix, and it has to do with expectations and the fact that Netflix is now one of those businesses that has performed so well for so long that, fairly or unfairly, expectations are higher for them. And, that's what you get for delivering solid performance quarter in and quarter out. All right. So you look at this and you think maybe a buying opportunity.
I think when they do their Q1 call in May, I'd like to hear more about exactly what is going on in Europe and the personnel they're bringing in there and what their game plan might be.
Johnson & Johnson, more of a household name than Illumina, hitting a new high after first quarter profits came in higher than expected, and they raised guidance for the entire fiscal year. They're getting pretty bullish up there in New Jersey at J&J HQ.
I think that's more of a reflection of the weakening U.S. dollar than much of anything else.
You think so?
Yeah, last year with a really strong U.S. dollar, it's been hurting a lot of companies that that report in U.S. dollars but have international sales, and they were having headwinds on that. And now that it's the dollar's falling back down a little bit, they say, "Oh, it's not as bad. It's not going to hurt us as badly this year. So let's up the U.S. dollar revenue that we're going to report."
Yeah.
So.
Yeah, that's part of the earnings story. Johnson & Johnson is a diversified healthcare company. They have over-the-counter products like Tylenol. They have a very big drug business and also medical devices. The highlight for them in the quarter is the drug side of the business. They are half the business is prescription drugs for the most part. And in the U.S., those sales were up close to 13%. This company is very strong in immunology. So if you think of like arthritis and psoriasis, very strong in cancer. Those two parts of the business are going gangbusters. And then it's the international side, the medical devices, that are a little bit of a struggle for them right now, relatively speaking.
One piece of news I saw that I liked is they're bringing back their baby formula shampoo to try to capture the millennials who are going more towards organic and perceived safer products. And so I saw a news article this morning that
Wait a minute. Johnson & Johnson is going to market baby shampoo
and that's going to save their
to millennials?
Bacon. Yeah.
Not necessarily millennials who have children, but
No.
Oh, okay. I thought it was
to millennial moms.
okay.
Oh, okay.
All right, because I was like, wait a minute. I'm trying to connect the dots on this one, and certainly this is as you said, Charlie, this is a big diversified business. They got a lot of moving parts, but I would love to be in the room if someone's pitching that.
I mean, I don't want tears in my shower either. Why is that just for kids?
I'm not pro tears. I'm just saying that's a little bit of a leap. The bidding for Yahoo's core business has closed. Yahoo's going to report earnings after the closing bell today. And my assumption is the first 78 questions on the conference call are going to be about the bids because the bidding is down to, I believe, just two entities. One is Verizon, which everyone expected. I don't think anyone, certainly I didn't expect the other one, which is a combination of TPG, which is a private equity firm, and YP Holdings. And YP Holdings is probably best known by its former name, which is yellowpages.com, which I didn't even know was still in existence, even in this new form. But as we were chatting about before we started taping, you peel back the curtain a little bit, they're pretty big in the digital ad business.
They are. They're bigger than Yelp. They do about $1 billion in revenue a year, about $120 million in EBITDA. So they're doing pretty well there.
And yet, I'm sorry, I look at this and I just think that the comedic skepticism is just ripe for the picking when you think about, for anyone who looks at Yahoo and sort of ignores the strengths of the core business. Because I do think that from a programming standpoint, what they're doing, particularly in sports and finance, are very strong. We are one of their partners on the finance strength, but I think I would say even apart from that, I mean that is when I'm doing research, that is sort of my go-to place, not just for the news feeds and that sort of thing, but also for charts and the like. But there are people who look at Yahoo and think, well, gosh, that's a company that really had its heyday 20 years ago, not unlike Yellow Pages being delivered to your doorstep.
Well, one of the interesting things about YP Holdings is that AT&T is a big shareholder in it, and with Verizon, they're not the majority shareholder. That's another private equity company.
It's Cerebus, isn't it?
I think so. They own 54%. AT&T holds around 40%. So with Verizon bidding, it's not too surprising that AT&T decided not to bid on its own. It dropped out, but it did probably sign off on the bid with part of YP Holdings making its bid.
Sure. I think anytime AT&T can mess with Verizon and vice versa, they're going to do that.
So they've disclosed who the two leading bidders are, but not like a winner or a price or anything like that.
No.
That's really odd.
Yeah. I don't. I'm trying to remember the last time something like this happened where there was sort of a consumer-facing company that was clearly up for sale, and that at the end of it, like when you hit the finish line, it was not, and here's who's won. It was, here are the finalists.
Yeah. It's almost like you float that information hoping like some better price or better suitor comes along to give you exactly what you want because these two are maybe not giving you all the boxes checked that you'd like to see. It's just a weird way to do this.
It is. And from what I read over the weekend about how Yahoo went about this bidding process, they were pretty close to the vest with the information that they were willing to share. And that's why I think that's one of the reasons some of the larger, better-known players just decided they weren't going to put in a bid. Probably Google chief among them. You could probably add Microsoft in there as well and IAC. But on the flip side of that, one of these two companies could end up getting a bargain here. I don't know. I think it's going to be interesting to play out. But I'm not. That's why I say. The first 78 questions on the conference call are going to be not about whatever quarter Yahoo just put up. They're going to be about the bidding process.
Absolutely.